Financial accounting. We've been talking about financial performance and those ratios that help us differentiate what's good performance and what's bad performance. Because we tend to get bogged down in those dollars and cents, don't we? So by doing ratio analysis, it allows us to ask better questions. So let's look at the solvency ratios. In other words, let's look at our responsibilities to others. The first ratio is called debt to equity. It's sometimes also referred to as debt to worth. It's looking at the proportionality as to who controls our resources, our assets. It's total liabilities divided by total stockholders' equity. If the debt to equity ratio is greater than 1, then our creditors have more of a say in our business than our stockholders do. Because if it's greater than 1, the liabilities are greater than our stockholders' interest. So in X7, if I take my total liabilities, which are my current liabilities plus my long-term liabilities, $36,000 plus $180,000, and divide it by my total stockholders' equity of $92,000, I see that my ratio is 2.3 times. So notice that my creditors have 2.3 times more of an interest in our resources than our stockholders do. Is that a good thing or a bad thing? The answer is it depends. It depends on how much you're paying interest. It depends on what your competitors are doing. It depends on your financial plan for the year or your strategies. So one of the things we can do to put it in context is to compare it with the previous year. And if I look at X6 and figure the debt to equity, I see it's 2.2 times. So as far as is there a growth in interest in my creditors? Am I using more of other people's money than my own? Yes, it's growing. So I'm growing and using more money or more resources of others to grow my business, to do my business, than I have in the past. Is that good or bad? Good, you learned the answer. It depends. Another solvency ratio that we can do is called interest coverage ratio. And what the interest coverage ratio shows you is the income before taxes plus your interest expense divided by your interest expense. In other words, how many times over could you have paid your interest? So in X7, net income before taxes was $42,000, interest expense was $14,000, adding those together and dividing by interest expense of $14,000, I see that I have interest coverage of 4 times. In other words, how many times could you have paid your interest expense this year? 4 times with the amount of earnings you had. If I compare that with X6, I see that it's 5.4 times. So am I slipping a bit as far as how many times over I could have paid my interest? And why is that? Well, we can see that we're utilizing more of the resources of our creditors than ourselves, so the interest coverage ratio will drop. So, solvency.